Mind over money. How behavioral finance affects your decision-making. When it comes to making financial decisions, I often think that we make rational choices based on our needs and wants. However, the field of behavioral finance has shown that our decisions are often influenced by psychological and emotional factors. These factors can range from biases and heuristics to social and environmental cues. Understanding behavioral finance can help us make better financial decisions and avoid costly mistakes. In this video, we will explore the various ways our behavior can impact our financial decision-making and the best ways to overcome these biases. So, whether you're looking to invest in the stock market or save for a rainy day, this post will provide valuable insights into the mind over money phenomenon. Introduction to behavioral finance. Behavioral finance is a relatively new field that studies how psychological and emotional factors influence financial decision-making. It combines elements of psychology, sociology, and economics to provide a more comprehensive understanding of how people make financial decisions. Traditional finance assumes that people are rational and always act in their best interests when making financial decisions. However, behavioral finance recognizes that people are not always rational and that their decisions are often influenced by emotions, biases, and other non-financial factors. It seeks to explain why people behave in certain ways when making financial decisions and how these behaviors can impact their financial outcomes. Understanding behavioral finance can help individuals make better financial decisions by identifying their own biases and emotional triggers. It can also help financial professionals better understand their clients and provide more tailored and effective advice. Overall, behavioral finance is a fascinating and important field that sheds light on the complex and often unpredictable nature of financial decision-making. The impact of cognitive biases on financial decision-making. Cognitive biases can have a significant impact on financial decision-making. These biases are essentially mental shortcuts that our brains take to simplify complex decision-making processes. While they can be useful in some situations, they can also result in irrational and inconsistent behavior when it comes to financial choices. One common cognitive bias is loss aversion, which refers to the tendency of people to strongly prefer avoiding losses to acquiring gains. This can lead to investors holding onto poorly performing investments for too long, in the hopes of avoiding a loss, instead of selling and cutting their losses. Another common bias is overconfidence, which can lead investors to take on risks that are not in line with their actual level of expertise or knowledge. This can result in overtrading, or taking on too much risk, which can lead to significant losses. Confirmation bias is yet another cognitive bias that can impact financial decision-making. This refers to the tendency of people to seek out and interpret information in a way that confirms their existing beliefs or biases. This can lead to investors ignoring important information that contradicts their beliefs or failing to consider alternative investment options that may perform better. Being aware of these and other cognitive biases can help you to make better financial decisions. By taking the time to consider your decision-making process and actively seeking out contrary information, you can avoid falling prey to these biases and make more rational and informed choices when it comes to your finances. Overconfidence bias and its consequences. Overconfidence bias is a common issue in the world of behavioral finance, and it can have detrimental effects on your financial decision-making. This bias occurs when a person has an excessive belief in their own abilities or knowledge, leading them to make decisions without fully considering all the available information or risks. In the realm of investing, overconfidence bias can lead to making risky investments without proper research or diversification, which can result in significant losses. It can also cause people to hold on to losing investments for longer than they should, believing that they will eventually turn around, when in reality, they may continue to decline. Overconfidence bias can also lead to overspending, as people may believe that they are better at managing their finances than they actually are. This can result in accumulating debt or not saving enough for the future. To combat overconfidence bias, it's important to take a step back and objectively analyze the situation at hand. Seeking advice from a trusted financial advisor or mentor can also provide a different perspective and help to avoid making hasty or uninformed decisions. Additionally, creating a well-researched and diversified investment portfolio and sticking to a budget can help mitigate the risks of overconfidence bias. By being aware of this bias and taking proactive steps to avoid its consequences, you can make more informed financial decisions and achieve your long-term goals. The role of emotions in financial decisions. It's no secret that emotions play a significant role in our decision-making processes, and finance is no exception. In fact, our emotions can have a major impact on our financial decisions, often leading us to make choices that may not be in our best interest. For example, fear is a common emotion that can lead us to sell off investments during a market downturn, even though history shows that the market tends to recover over time. Similarly, euphoria can lead us to make impulsive investment decisions when the market is soaring, which can lead to losses when the market inevitably corrects itself. Greed is another emotion that can impact our financial decisions, leading us to take on too much risk in search of high returns. And, conversely, we may be too cautious due to a fear of loss, which can cause us to miss out on potential gains. Understanding the role that emotions play in our financial decisions is crucial to making sound choices. By recognizing our emotional biases, we can take steps to counteract them and make more rational decisions. This can include setting clear financial goals, creating a long-term investment strategy, and seeking the advice of a financial professional. By doing so, we can better navigate the complex world of finance and achieve our financial objectives with a clear and level head. Conclusion and key takeaways. In conclusion, behavioral finance can have a significant impact on our financial decision-making. Understanding our own biases and tendencies can help us make better decisions when it comes to money. One key takeaway is the importance of setting clear financial goals. By having a specific target to work towards, we can avoid succumbing to impulsive decisions or temptations that might derail our progress. Another important takeaway is the value of seeking out advice from trusted professionals. Financial advisors or planners can provide objective guidance and help us make decisions that are in our best interests. It's also important to recognize the role that emotions play in our financial decisions. By learning to manage our emotions and separate them from our financial choices, we can make more rational decisions and avoid costly mistakes. Finally, remember that financial decision-making is not one size fits all. We all have different financial goals, risk tolerances, and life circumstances that will impact our choices. By understanding our own biases and tendencies, and seeking out the right guidance, we can make financial decisions that are right for us and our unique situations. I hope you found my video on behavioral finance informative and helpful. It is essential to understand how our behavior can affect our financial decisions, and I hope this video has given you some insight into the topic. By being mindful of our emotions and biases, we can make better financial decisions that will benefit us in the long run. Remember, when it comes to money, it's not just about the numbers, it's about our mindset and behavior. Thank you for watching, and I hope to see you again in my next video.